The stock market should have crashed already. Every major indicator is flashing red. Consumers are drowning in debt. The economy is clearly weakening. And yet the market continues climbing like nothing is wrong. Today I'm going to show you exactly why. Because once you understand what's quietly keeping this market alive, you'll realize the real danger isn't that the crash hasn't happened. It's that it's being delayed. My name is Seth. I've spent decades in fintech and banking. I have a finance degree and an MBA. And even with all that background, there were moments I looked at the markets and said, this doesn't make any sense. Media headlines predicted recession after recession. Inflation was raging, earnings were slowing down. Consumer sentiment was collapsing, and the market still drifted higher. And then I discovered something important. Markets don't collapse when the data looks bad. They collapse when the forces holding everything together finally fail. And when you understand those forces, today's market starts to make perfect sense. Let's begin with the obvious. Every major valuation measure says the market should already be much lower. Warren Buffett's favorite metric, total U.S. stock market value divided by U.S. GDP, is at levels we've never seen before in history. The market cap of all U.S. public companies is around $66 trillion. U.S. GDP is about $30 trillion. That means the ratio is roughly 220%. For reference, anything above 100% is considered overvalued. Before the dot-com crash in 1999, this ratio hit about 115%. And the market still collapsed more than 60%. Today we're at almost double that level, yet the market keeps rising. Then there are the PE ratios. Historically, the S&P trades around 15 or 16 times earnings. Right now it's sitting somewhere around 25 to 28. But the real story isn't the index, it's the companies lifting the index. Nvidia is trading around 50 plus PE. Amazon and Microsoft are in the mid-30s. And Tesla is sitting above 280. Think about that. Investors are paying $30, $40, even $50 for every $1 of earnings. Nobody would pay $50 for a $1 candy bar. Yet in the stock market they do it every day. And here's what should really concern people. Before the dot-com crash, S&P PE ratios were hanging out in the high 20s and low 30s, almost identical to where they are now. All the warning signs we saw before past crashes are here again. And yet nothing's breaking. So the question becomes, why hasn't the crash already happened? The answer is almost nobody talks about this because it's not obvious unless you look beneath the surface. There are two massive forces still keeping the market inflated. The first is quiet, disguised government stimulus. Officially, stimulus checks ended years ago. But unofficially, the government never stopped stimulating the economy. They've simply shifted to more subtle forms of support, expanded credit programs, increased federal spending, corporate tax benefits, and indirect subsidies. The U.S. government collects about $5 trillion per year in taxes, but spends about $7 trillion. That extra $2 trillion flows through corporations, federal projects, contractors, employees, and eventually into the consumer economy. Whether people realize it or not, that keeps revenues high, which keeps earnings higher than they should be, which keeps the stock market propped up. But this spending is not sustainable. The national debt is around $38 trillion. Annual interest payments are over $1 trillion. Eventually the government can't keep injecting money at this pace. And when that slows down, the market won't like it. The second hidden force is dollar devaluation combined with persistent inflation. When a currency weakens, everything priced in that currency goes up, including corporate earnings. And right now, demand for the US dollar is quietly decreasing. BRICS nations are pushing for trade outside the dollar. Global treasury purchases are weakening. Combine that with inflation. Companies raise prices, earnings rise. And Wall Street thinks profits are strong, even when real growth isn't. These forces don't stop crashes. They only delay them. And when confidence finally breaks, the market won't slowly decline, it will violently correct. The crash isn't cancelled. It's waiting. The longer it's delayed, the worse it becomes.